Welcome back. Now, slowdown in the infrastructure landscape in Australia and New Zealand has weighed on Aveng's annual performance. Revenue decreased across the infrastructure and mining segments in line with expectations, but a better performing building segment offset the impact. CEO Scott Cummins says segment strategies are strongly aligned with current market trends. He joins us now to unpack the year that was. Thank you so much for your time, Scott. Let's actually start off with that impact on revenue, that decline, of course, due to the softer infrastructure markets in Australia and New Zealand. Just build on that for us in terms of what's weighing in that sector, what's weighing on that sector in that region.
Yeah, good evening, Zinathi. So first of all, that was the downturn in revenue was expected. We kind of saw that coming. It's a direct result as a consequence of the hyper-escalation that occurred after that COVID period put a lot of stress and strain on customers' budgets. So a lot of projects which they originally thought were going to be worth, say, 200 million, once they went out to tender, they found that they were really going to cost 300 million, for example. And so that meant that a lot of time needed to go back. Do we de-scope the project? Does the customer go get additional funding? Or do we look at value engineering to resolve that difference between the budget allowance and the cost? So that all took time to work its way through the various markets. And then once the equilibrium was reached again, either jobs were de-scoped, re-engineered, or budgets were increased, then the flow started to come back into the fore. Also, we had a swing from transport infrastructure across to the more specialised infrastructure, water, wastewater, marine and defence. And with that transition, that also took a little bit longer than expected. But the encouraging news is that we're now seeing some of those projects flow through that are getting awarded. Since the 30 June close of FY25, we've been awarded in excess of $800 million worth of work across the group as a consequence of those things starting to flow again. So a very encouraging start to the next financial year on the back of that downturn that was anticipated.
All right. Well, I mean, you talk about, some of those projects with that hyper-escalation after COVID, where now things started to seem more expensive. And of course, we have seen some headwinds and losses experienced in the J108 and the Kidston projects. What level of outflows are you factoring in for the completion of these projects?
Yeah, so maybe I'll talk about each one independently. The J108 project is nearing completion now. We've been meeting our basic structural completion dates and handing those over to the client as expected. So in much more predictable space, nearing conclusion of discussions with the client with regards to some commercial issues from that project that will provide some cash inflow. So that's relatively stable when we think about the J108 project. The Kidston project, however, has experienced some additional delays and costs associated with some massive flooding events that took place in Queensland just during the last 6 months, which meant that we needed to demobilise everybody from site and gradually remobilise them over time. So we lost about a 10-week period through that remob period. So the additional costs and time associated with that project, the costs that go with that will be an outflow gradually over the next 12 to 18 months of that project while it continues its execution. Because the project at this particular time is actually cash positive, so the losses to be incurred will result in the cash flow over the next 12 to 18 months.
All right. Well, let's drill into the mining segment. I do understand that there was a mixed picture, even though there was an overall, softer performance in terms of revenue, but mixed. But really the problem coming from one contract where you were hit by contractual matters. Just expand on that for us in terms of the impact of that dispute.
Yeah, so we've had the client, for reasons of their own, have introduced a mine plan for the mining at that site, which has meant that we haven't been able to meet our productivities and operational efficiencies in mining that particular mine site. The contract allows for us to submit commercial claims that's associated with the impact that we incur. And then you always hope that when you submit those claims, which are supported by our contractual position, we can go through an amicable process of negotiation and settlement of those claims. Unfortunately, in this particular instance, we've had to take those claims to a formal dispute resolution process, again as defined by the contract. So we'll be working through those claims progressively in that formal dispute. From my perspective, we've tried everything we can to settle those outside a formal dispute, but it's become necessary that we do that to protect our rights under the contract on that particular project.
Yeah. Scott, just, expand on what your pipeline of projects looks like from here on out. You mentioned something very, very interesting, that what you're seeing is aligning with market trends. You spoke about infrastructure, for example, moving from transport to more specialized areas. And I'm wondering if also that pipeline is impacted by, the uncertainty from the macroeconomic environment, and maybe if you are benefiting from some of those movements.
Okay, there's a fair bit to address there. So first and foremost, a few years ago, we defined our operational strategy for our infrastructure and building groups. So I'll start with infrastructure, to focus on those specialty type projects in anticipation of the move away from transport. And as I said earlier, water, wastewater, defence, marine, emerging energy, those types of projects which we are now seeing come to fruition, which is good news. Similarly, for our building business, we didn't want to be a builder that focused on developers and building residential apartments and so forth. We're focusing where we could see the demand being in education, recreation and healthcare to support the growing population of the cities in which we operate. And again, we're seeing a lot of investment in those areas, working for the government to bring to fruition those types of facilities. So it's that alignment between future spend, where we have our expertise, and intellectual property, we're able to bring those to the fore and offer the value to the client. So that's the good news. With regards to the overall world economic environment, I think I'm probably like every other CEO in the world. We're not exactly sure where that's going to go, so we watch it very, very closely. But as we sit here today, the projects that we're pursuing and the work that we're executing is not being directly impacted to a negative effect as a consequence of the global situation. But of course, we know how quick that can change, so we'll be watching that intently.
All right. Well, something else that I've been watching, Scott, is your share price today up almost 8% the last time I saw, so quite pleasing movements there. So thank you so much for your time and for giving us more detail on those numbers. That was Scott Cummins, CEO of Aveng.